right, let's get this party started. Hi, my name is Kelli Garrett, and I'm one of the partners of Rehab Wallet. And we're going to go into a little detail today about private lending and hard money lending inside or while your multifamily deals or you're waiting on a multifamily deal to happen. So I'm going to go into a little high level information about that. But before we get started, I'm going to talk about the MFIN con that is in June. And today there's going to be $100 off coupon for the people in this webinar. So if you're interested in that, we're dropping that right now in the chat, and hope you guys join us. It's a great event for a lot of multifamily investors. In that in-person event with some wonderful speakers. Started it in person last year before, I'm sure a lot of you know, but it was virtual, and now it's in person, and we get a lot of relationships are built there. So it's in Charlotte in June. So everybody join us. I'm going to share my screen for a second, and we will get started. All right, so I'm sharing my screen right now. I want to kind of talk for a minute about how to become a private money lender in between multifamily deals. I'm going to tell a quick story real quick. But so a lot of you might know passive investing. Obviously you do, passiveinvesting.com. And we were able to kind of start a partnership in June of 2020. And I had mortgage experience, and obviously Dan, Danny, and Brandon have, they can raise money. So I went to them. Danny and I are great friends here in Charleston. We both live here locally in Charleston, South Carolina. So I went to him and said, you know what? I'm private lending my own personal money. And I said, you know what? My phone is ringing off the hook, but I'm running out of my personal money to lend. I think we have something. If you guys can raise the money, I can lend it out. And so that started in June of 2020 with one loan, and we're going to go through that a little bit to kind of talk to you about that private lending kind of journey so far with passiveinvesting.com. So a little bit about me. I have 12 years of corporate America experience. You know, I love business ownership. I probably have, I've bought and started and or sold 8 different businesses in my career, of which one was a mortgage company, a mortgage brokerage for approximately 10 years. During this time, I've been in the business for over 2 decades. I'm a real estate investor. I personally invest now passively with passiveinvesting.com and a few others. I flipped for over 18 years. And so it kind of allows me to, through the lens of a flipper, started my private money lending company. And that was just because I sold off we had over 300 units, and I sold a lot of those off about 3 or 4 years ago, and just took that pile of money that I had, and I started private lending before Rehab Wallet, before I partnered up with passiveinvesting.com. And so obviously there's a need in your community, in my community, for this private money lending. And in 2020, June of 2020, we started a partnership together with passiveinvesting.com, and our company that we lend out of is called Rehab Wallet. And so there's a little difference between passive investing, or difference between private lending and hard money lending. Private money lending is really what I was doing with my own personal money. The hard money lending company is now a company formed around this lending of money. And so I think the only 2 differences that I actually have right now, and to explain the difference between private lending and hard money lending, is just a big corporate veil around the hard money lending piece. It's just a way, and a way that different people have been able to explain what hard money lending is. And hard money is kind of just around, it's collateralized around hard assets. So that's a little bit about me, but kind of the next step is like, why private private money? Well, and why be a private money lender? As you know, passiveinvesting.com has multiple divisions in their private equity firm, if you will. They have multifamily, storage, car wash, hotels, and their fifth arm is lending. And I'm a partner inside that fifth division of lending. So, every private equity firm needs, multiple streams of income, if you will. Some of you guys that are in the multifamily space might get very large pops at the beginning with your fees, and then you wait around to when you sell it, or when you buy another one, you have, that's when you guys get paid. Well, private money or private lending could be a way that you could actually have those monthly drips and some short-term money coming in as you wait for the next really good multifamily deal. That's what passiveinvesting.com had decided to do. That's what we sat down as partners and decided to do. And we just started, again, the division for lending within a debt fund. Year to date, we've raised over 90 million in our debt fund in 2.5 years. And we've lended out approximately 150 million in 2.5 years. Now, let me explain the difference in the two. We do short-term lending, and we're going to get into that in a second, but we do short-term lending, 6-month terms, 9-month terms. So we can almost, if we have $100,000 come in, we can lend that out twice in a year. So we're lending it out to 12 for 12 to 15% interest APR, but we get fees, 2 points, and a lender fee each time we close a loan. So you not only get your interest, but you also get your fees as the money is compounding. Okay, and we're able to use that same 100,000 to do that again the next 6 months. Our average turn of our loans right now is approximately 153 days. So it's right at 5 months. So it's not even staying in there 6 months. Now, as the market turns, of which it's turning a little now, we all know that in the single family world, we're expecting that those days on market to extend a little bit. So we should expect that to extend as well, right? So it just keeps your money compounding instead of it just sitting. If you have money in a capital account for some of your multifamily deals, maybe you can take it over and put it in your own debt fund and let it compound monthly that way. So when you get started, let's talk about the fund first, and then we'll get into some detail into the guts of the lending company. But we had to start a debt fund first, right? 506C for accredited investors only fund. So we pull money in a fund, and then we lend it out over here. So we pull money in a fund, and we lend this money, we pay our investors 6% inside this debt fund. We lend it out at 12 to 15%. That delta is our business plan. Okay, so we've decided to use our debt fund for hard assets. Our investors' money is collateralized over all 700 plus loans that we have on the books right now. It's not collateralized on one deal. So a lot of people might ask at times, like, what happens if you have a deal go bad, for our investors? Well, we would have to have a lot of deals go bad for our investors to be at risk. Our job is to be good stewards of our investors' money, my personal money, and all of the partners, Dan, Danny, and Brandon's money is inside this debt fund as well. So we are good stewards of investors' money, and it's collateralized over all the loans. So we started a debt fund. Now it's time to go lend it out. So the specifics of lending, and this is very high level, and I'm going to explain to you later of a place that we actually explain this intensive private money lending training in 2 days, that we go in depth of this, and we'll give you a little snapshot of where that is. That's going to be in Columbia in January the 23rd and 24th. We'll go over that later. But right now, I'm going to give a high level of how to be a private money lender inside a debt fund. Your first and foremost is to start originating. You got to go originate a deal. It could be you at the beginning. It was me at the beginning. We started with one loan in June 2020. We had to decide. I tease the guys right now and say, you know, I don't think they had confidence that that I could lend all this money out. And sadly, I don't know that I was sure that they could raise this much money in this debt fund, because they raised so much money in their other funds. I think we were just kind of like courting during this time of this partnership. But we started with one loan in June 2020. I needed to build the business around this, because I knew if we could make it work, if we could raise the money, that I knew I could lend it out. So your first part is being an originator. You're originating the loan. You're out networking. You're out talking to different people. Once again, I told you I flipped single family for over 18 years. I'm networked in this Charleston, South Carolina, Greenville, Columbia arena. I'm engulfed here because I was flipping for so long. Our team now, of which we did at the beginning as well, but we sponsor these local real estate investor networking meetings. We set up a booth. We're there networking to get our customers. But as a private lender, again, we now do a lot of business. But at the beginning, when I was private lending, I did the same thing. You just got to start networking, and then you form, when you're ready to kind of, get out of the business, the day-to-day business, you need to set up your sales team. So origination is your sales team. We have a director of sales now, and she is that frontline gatekeeper that says, okay, this loan can go in, or no, this loan can't go out. This loan can't come in. That person needs to be very experienced. Our director of sales has over 20 years of experience. I wanted to have somebody in that seat that has gone through a market change, right? So she finds qualified buyers at investor meetups, and those originators is your sales team, and they have the relationship with the borrowers. Once they get a deal that they like, that your origination team likes, they input the data in our software. We have chosen a software called Mortgage Automator. And we've chose to use software as we got bigger. At first, you don't need one. If you want to start with a few loans, create a checklist. At our intensive in January, we're going to give out our checklist that has been built for 2.5 years as we have grown. But we now input that data into software. And once she inputs the loan, she likes the loan. Rehab Wallet gave a commitment that we will do the loan. She sends out a loan term sheet. And this is a example of a term sheet that we send out. It gives the total loan amount. It gives the purchase price. It gives their rehab costs. Obviously, this makes it crystal clear to our borrowers what they are agreeing to. They know their monthly payment is going to be $1,275. They know their down payment is going to be $10,000. They know that we're going to charge 2 points at closing, and so that origination fee is there. They're crystal clear. It's theirs, no question. Our lender fee is $2,000. You're crystal clear of what you're signing up for. So at the closing table, we don't have any problems. We're agreeing when we send this term sheet that we can close on October the 11th with no problem. This is our Rehab Wallet's commitment to lend. And the originator sends this out to the borrower via DocuSign. And when they sign it and it comes back, then we're off to the races to get them to the closing table on or before October the 11th. All right. So we go from processing, we go from the term sheet and the origination, and now we're ready to go to loan processing. When they sign that term sheet via DocuSign through our software, again, we show all this in our intensive and how this works. But then it goes straight to our loan processor, and our loan processor gets a term sheet in their inbox. Now, the processor's job is to collect all that back end stuff, right? That people hate to send in. You know, the processor's objective is to get the lender and borrower at the closing table. They're behind the scenes getting the documents. They're collecting things like insurance. And she or he, whoever's your processor, make sure that the insurance has your business name and your address as a mortgagee. Because if they were to have a problem with their insurance, or their insurance is canceled for any reason, you as the lender, because you are the lender, will get notified. We do all of our loans in an LLC name to kind of, you know, so we're not as regulated. When you're dealing with a personal name or a person, you have to deal a lot with the, you know, fair housing laws. But if you're dealing with sophisticated people that have a company, you're not regulated. So we gather their articles of organization and their operating agreements to make sure that they are, whoever's signing is the person that should be signing. We get a scope of work for the rehab, attorney's information. The loan processor is gathering all the back end work, right? Then they also are dealing one-on-one with the paralegals at the title or the law office. They're dealing with them to prepare all the closing and to ensure that we have clear title. This person needs to be super detailed. This employee needs to be very capable of juggling a lot of balls at one time. At any given time, we'll have, you know, we're closing anywhere between 35 and 50 loans in a month. So she needs to work on one file for 5 minutes and then be able to go grab another file and work on it and be able to juggle all that to ensure all those closings get done in a given month. She then prepares our mortgage or deed of trust, whichever state you're in, the promissory notes. And all those were prepared for us from our attorney, right? Now we just, you know, we just, it's a template. And she's putting in the name changes on every loan. Of course, the loan amounts and the terms of the loan are different for every loan, but she's kind of just using that as a template each and every time. So now, okay, we've originated a deal, we've networked, we've got us a borrower, we've originated it, we've sent it out, we sent out a term sheet. Now it's in processing. She's collecting all those specific documents for the closing. And now it gets closed, right? It's closed, it's done. They're starting their rehab amount. They're starting their rehab. There's really nothing that we do except maybe a draw for the rehabs. And now it's in servicing. It kind of goes from origination to processing, and now it's been servicing. It's in servicing department. And the servicing department is literally collecting the payments. So somebody's got to go collect the payments each month, right? We have chosen to draft from the account every single month. You could always get a check. You could do it however you want to do it, but we go and use our software to have a file, a notch of file, go straight to our bank. And it tells our bank, you know, that you draft for Kelli LLC, you're drafting $1,000 every first of every month, and it drafts that account. If for some reason we have NSFs, it happens, right? It just happens. When you have 700 loans out, it happens. Somebody's going to not have enough money in their checking account or in their business account. They're going to have moved accounts. They're not told us that their accounts have changed. It happens. So we have to have a person to be able to, at this point, we have to have a person able to go deal with all that. It goes from loan servicing. And let me add, inside this loan servicing is your draws. So let's go back for a second. We have a term sheet. This term sheet here shows that this example has a $30,000 rehab cost. We are not dispersing this $30,000 at closing. We, the bank, we're holding on to that $30,000 until they get $30,000 worth of work done, right? A lot of you have built your own homes before. A lot of you built your own, you might have dealt with this with the bank in some of your multifamily deals. But they send us videos or pictures. They're walking in on the video from the street, from the mailbox, showing us the street number to make sure we're at the right house in case somebody wants to get all sneaky and show us a video from another house to get their money. I don't know. I'm just trying to keep everybody, with integrity, if you will. So if they send us videos of the floors being done and show that it's completed, the HVAC being done, and maybe the roof being done, let's say, and all that equates to $10,000. And where I get that from is because they have sent in a scope of work from their contractor. So they're showing me pictures and wanting, X amount, $10,000. Well, I go back and we compare the scope of work to their pictures, and that's the amount that we're sending. So these rehab costs, even though they're paying interest on the entire loan amount of $120,000. Their purchase price was $100,000, but we asked for 10% down of the purchase price, and we'll fund all the rehab as long as my LTV is 70% or less. Okay, so the total loan amount's 120, and the after repair value is 175 once all this is done. Once they put 30,000 in, they use a scope of work. We send appraisers or BPO agents out with the scope of work, and it says, okay, if they put in $30,000 worth of rehab into this 123 Main Street, and they put granite, and they do LVP, and they do, great job on this rehab, what will it appraise for? The after repair value. We're looking for 70% of that value, because that gives us enough room in case the market shifts. All right, so we've originated, sent out a term sheet. The originator sends out a term sheet, or the loan officer or originator, whatever you want to call them, sends out a term sheet. Then it goes to processing. Next, it goes to servicing. We're collecting payments. And now it's time. They've rehabbed it, and they've got it on the market, and they have sold it. So the borrower now has paid off the loan. You're still not done. You still have some paperwork to do. You got to close out that file. You got to save that file within Mortgage Automator, or just a manila filed envelope. I mean, just if you're wanting to just do it private lending, you can do all the checklists inside a manila envelope and keep this hardcore paperwork for 2 to 5 years. And then last but not least, you have to satisfy a mortgage. So what that means is that we're saying that it's paid in full. I don't know if you've ever had a situation. I know I had in 18 years of flipping and all those closings that I've been to, is that there was sometimes an old mortgage hanging, right? That's just because some lender, usually a private lender, hasn't went and satisfied the mortgage. And what that is literally is a one document notarized that's saying that it is paid in full. And that is recorded at the courthouse. Let's not overcomplicate it. Let me explain to you what that means. Is that if you're at the closing, or your borrower's at the closing, they've closed the property out, they've sold it at the end, right? At the end, they now have rehabbed it and sold it. You just ask that closing attorney to prepare a satisfaction, and would they record it? And they do it for $10. They'll charge you $10 off your wire. Once they wire it back, they're always going to the courthouse. They have runners back and forth to the courthouse, and they record that satisfaction. And they're happy to do it because as a law office or a title company, they're always having to deal with past old mortgages not being satisfied. So it might sound a little complicated, but it absolutely is not. It's really just like everything else. It is a relationship. You have a relationship with the borrower all the way through to the satisfactions. That's really all it is. If I had to say, we have 9 people on our staff now, and we started with 2, and I was one of them in June of 2020. So in 2.5 years, we've grown to 9 people, but with that has just been, you don't want to add the team until you have the business to add the team. But I just suggest that there's a lot of people that already have processor experience that do it virtually for a lot of people. So if I didn't have a lot of business for one processor, I could go out on Indeed or somewhere and find a processor that would process my loans for me as I'm building my business. And you're out there just networking, and they know how to handle all the processes of it. But we're going to do this. I know I just explained the whole emphasis of private lending in 28 minutes. And we get into the really just nitty gritty of private lending and hard money lending on an intensive that we're doing in Columbia, South Carolina, the 23rd and 24th. If anybody has any questions about that, we're going to put that in the chat as well. And I think there's still a $500 off coupon on that one. But it's just an early bird coupon to be able to come and enjoy. And not only that, you're able to see how the fund is actually started at the beginning, because we're going to have passiveinvesting.com partners there as well. And being able to network at night to ask any questions that you have about private money lending. Look, it's been just a place for passiveinvesting.com to park some money on a monthly basis. Now, our debt fund, let's talk about this debt fund for another 2 or 3 minutes. Our debt fund on the front end is a 90-day liquidity fund. So we have agreed in our PPM that if you put your money in our fund and you get a 6% APR return on your money, you get a monthly dividend, or if you leave your dividends in, it will compound monthly. So we have a compounding feature of that. But for whatever reason, if you put your $100,000 in, our minimum investment is $25,000. But if you put $100,000 in January, and now it's December, it's tax time, January, tax time to pay some taxes or what have you, you can get your money back out. It's like a high-paying CD. That's kind of the way I have looked at it. And so a lot of people use that as a place that you can just park some money. It has a liquidity function, to ease some nerves in case somebody, a lot of people, when passiveinvesting.com is raising money, they're raising money for multifamily, for car washes, et cetera. And that money they're raising is in these funds for 5 to 7 years. So the investor knows their money, they can't touch their money for 5 to 7 years. This is a fund that they can touch their money. If they, as simple as an email back and forth to get your money back out. So yeah, we have return of capital calls all the time. But it's just a balancing act between our fund and our lending arm. But we're going to go into this extensively. I'm going to have a few people on my team come in that's going to talk in depth about processing, in depth about origination. And I didn't even talk about compliance, and we'll talk about that there. But there's another piece of the pie with compliance, is that what happens if a deal goes bad, right? Our compliance department has to ensure that and handle the foreclosure, because we have to foreclose and know all the foreclosure laws in every state, right? We're only in, and we've been able to lend right at $150 million in 2.5 years in South Carolina, North Carolina, and Georgia. And when I say those 3 states, 72% of our business is in South Carolina. So that amount of money that we're raising, we have no need to go to the Midwest or out West. We have no need to go there. We understand the Carolinas. We understand Georgia. We understand the Sun Belts. You know, we understand, we don't understand the negative 10-degree weather and what that does to our collateral. So why go out there, right? Don't feel like you have to do every state of the union within your fund. That money goes, it doesn't go that far. If you think about the lending, our average loan amount, I didn't say this, but our average loan amount is less than $250,000. So we've done, $150 million, $250,000 at a time. Okay. We like that. And this is why. If something happens and we had to take that loan back, you can rent that type of loan amount very easily and still cash flow. I always have that question. Well, what happens if you have to take a loan back? We will open up a REO division, a bank-owned division, and we'll either flip it ourselves or we'll rent it out until the market changes or something, and we can rent out that loan amount very easily. Again, it's going to happen. We got over 700 loans out, right? If I'd be silly to think that something's not going to happen. So we got to have a team. I needed to have a team ready, or at least one person, right? It's not really a team. It's a one person, a compliance officer that is regulating and understands every state that we in and every foreclosure law that we're in, so that when and if we had to take back a loan, she would handle that. Okay. So again, you don't have to start with that. We didn't start with that, just like you're starting with any business. Everybody wears lots of hats, and then you take one hat off and go hire someone. So that's it. We have, again, our intensive is January the 23rd, 24th. And last but not least, please do not forget about the MFI and Con in Charlotte from June the 12th to the 14th. And I'm going to open it up for some questions. I've been talking now for 30-something minutes. So I'm going to open it up for any questions. Let me see. Having questions. So the minimum hold time is 3 months. So if we invest into one of these funds, it's 6% returns. So the minimum hold time is 3 months. If you're investing in, if you're wanting to invest in our fund, your money can stay in there as long as you want it. So we take the money that's inside this fund and we pay our investors 6% APR, or 0.5 point a month. Okay. We take that money and we lend that money out to our borrowers. Next question. What are the 5 to 7 most important things to know when just starting in private lending? 5 to 7. I would say, know every one of those departments, understand that there's multiple departments. I would say the most important thing is either have your own money. And again, I don't want to assume that everybody understand that you think that you have to have a fund. because you do not. I've used my own personal money for like 4 years, 3.5 to 4 years. And so I use my personal money. And when I would do a mortgage and a note, the lender would be my company that I'm going to lend out of. But if you're wanting to scale this private money lending company, you're gonna need a fund. Okay, so that would be that thing. That most important thing would be you don't have to have a fund. If you're your first employee, if you don't have any mortgage experience, I would bring on somebody that has a mortgage experience or lending experience. I would, think the end in mind, meaning like just know that the possibility of getting a foreclosure back, or that you would ever have to foreclose, that there's a possibility you could get a loan back, but it's okay. It's just like buying low, right? And selling high. If you are originating and if you are networking and you're getting loans that are only at 70% LTV, you're going to be okay. 65 to 70%. Our average loan right now is 66.7%, and we track that every single week on our team's call. So I want to see what our term sheets are going out and what LTVs are going out. I would say experience first. Your first employee needs experience. May we access this recording to share with our team? How may we contact you for additional questions? You can always contact me. My email is Kelli, Kelli at rehabwallet.com. And Anthony, if you have any inkling of a thought to get in this business, I would suggest if you can make it to our intensive, that you do it, because it is, we're going to go into the very fine tune of how to start this business, how it started, and all of our paperwork to help you during your company that you want to start. We'll give you all the paperwork necessary to get started. Anybody else? Questions? That's 5. Chat. I don't know if I'm going to chat. So our team is handling the support, the chat support. Is it possible to build this business from a country outside the U.S.? I'm sure it is, and I'm sure a lot of these bigger lending companies have done that. I'm probably not the right one to answer that. But just like what we did at the very beginning of starting Rehab Wallet, we got our legal team who helps us at passiveinvesting.com. We had them prepare all of our paperwork, right? We're not preparing all the promissory notes, the mortgages, the deed of trusts. We're not preparing that. We're just copying and pasting on a given day for each loan that we want out. We're not preparing all that. It's literally a highlight underneath where names should go is got a highlight. And I put, if my borrower is Kelli LLC, my processor puts in Kelli LLC to remind her where to put everything that needs to be inputted in that mortgage. But the mortgage note, deed of trust has all been done for us. So I would suggest get with the legal team to answer that. So I may have missed it, but I had a couple of calls come in. However, do you provide verification of funds letter? Okay. That's a great question. So that is yes. So let's say that you have a borrower that uses Rehab Wallet. We are the preferred lender. They're going out and making offers on deals, right? And when they make an offer, when they send in the contract, they also send in their verification of funds, so that the seller will probably take their offer or hope that they'll take their offer because they're verifying that they have the funds to close the thing, right? But we definitely send out verification of funds, mostly to our VIP borrowers, because we need to know. Well, first of all, we want your business, right? We want, but we don't need everybody's business. We do not take first time flippers business. There's no need for us to, okay? Because we want experienced borrowers. We don't really want we don't really want to set up that REO, bank on flipping or lending or rental business. We really don't want to take back deals, right? At all. So we want our gatekeeper, our originator, to only accept deals from very experienced borrowers. So we will give that experienced borrowers, you know, $1 million verification of funds, and they just send that thing in on every deal. They might, because you got to remember, as a flipper, you're looking for deals. If you're sending contracts in, you might have to put in 50 contracts to get one deal. Y'all understand that if you're multifamily, same thing for multifamily. So we do send verification of fund letters out for our VIP borrowers. Trying to see, can you attend the event in January? If someone kept their funds in your fund for 12 months and initially invested $100K, what would their payout be after 12 months? 6%. 100,000 times 6%. That's going to be how much money you would make inside that fund, collateralized over all the loans. What is that, $6,000? So the monthly, okay, good question. I just want to I wasn't sure about the compounding monthly aspect. Okay. All right. Let's go back for a second. Good question, because that's saying that if you've got 100,000 in our fund and do not take monthly distributions of 0.5 point a month or 6% a year, if you don't take those monthly distributions out and you leave that in, it's compounding, and it kind of equates to about 8% total APR, because this is the way it does. And you can do this on your calculator. 100,000, instead of taking the distributions of 500 your first month, your second month, your amount is $100,500 compounding at 6%. So what Danny Randazzo, of course, a lot of you might know him at passiveinvesting.com. He's a genius with numbers, and we have factored that in. It's approximately 8% on your money you can make. Hope that helps. All right. Listen, I think that's all the questions. I'm going to go down one little bit. I think that's it. Guys, thank y'all so much for your time. I appreciate this. I hope this helps anybody. You guys can email me within this MFIN Nation network, if you will. You're welcome to email me with any questions. I hope I can help you. But if not, maybe come to our intensive in January, and you can really get a ton of more information there. And all of our paperwork that we've actually gotten from our legal team, but more so than anything, our checklists, our processing, because our processing piece of the pie has been changed and revamped and added to over the last 2.5 years. So again, guys, thank you so much for your time, and we'll talk to you soon, or come and meet us. We'll have our booth at the MFIN Con at Rehab Wallet. Come introduce yourself, and I look forward to meeting everybody. Talk to you guys soon.